You worked all month, your salary says $2,000, but your bank account? $1,456. Where did the rest go? If you don't understand money in 2026, the system will quietly drain you. Today, I'm breaking down the financial basics every adult should understand. Taxes, banks, inflation, credit scores, investing, in plain English. Let's start with the one that hurts the most. 1. Taxes, 2026 context. Taxes aren't new, but in 2026 they feel heavier than ever. Income tax hits your paycheck, sales tax hits what you buy, capital gains tax hits your investments, and then there's Social Security and Medicare. Think of taxes as the cost of living in an organized society. Governments use tax money to build roads, fund schools, regulate businesses, support healthcare systems, and manage national defense. Now here's what most people don't realize. The more you earn, the more strategy matters. In 2026, digital income, freelancing, YouTube gains, crypto gains, side hustles is being tracked more closely than ever. Tax efficiency is now a skill. If you don't understand how taxes work, you'll overpay. If you learn the rules, you keep more of what you earn. 2. Banks, and why your money isn't just sitting there. You deposit $1,000, you imagine it's safely sitting in a vault. It's not. Banks use something called fractional reserve banking. They keep a small percentage, they lend the rest. Your money might be funding someone's home loan, car loan, or business expansion. That's how banks make money. They pay you 3 to 5%, they lend it out at 7 to 12%. In 2026, banking looks different. Digital banks, instant transfers, UPI, Apple Pay, real-time payments, online-only savings accounts with higher yields. Most developed countries insure deposits up to a limit. That's what makes the system stable. Banks are not vaults, they're money circulators. 3. Interest, your best friend or worst enemy. Borrow $1,000, pay back $1,280. That extra $280? Interest. Interest is the cost of using someone else's money. There are two types: simple interest, calculated once, compound interest, calculated on interest too. And this is where things get serious. Credit cards in 2026 often charge 20 to 30%. Miss payments and your debt multiplies. But investing at 8% compounded annually, that's how wealth quietly grows. Interest works 24/7. The question is, are you paying it or earning it? Rule: if you're paying high interest, eliminate it fast. If you're earning interest, give it time. 4. Inflation, why everything feels expensive. Groceries cost more, rent costs more, fuel costs more. That's inflation. After the global inflation spike earlier this decade, most economies are trying to stabilize around 2 to 3%. Inflation happens when demand exceeds supply. Governments print too much money, supply chains break, energy prices surge, consumer expectations shift. When inflation rises, central banks increase interest rates. Higher rates, borrowing becomes expensive, spending slows, inflation cools. Here's the truth: inflation silently punishes savers. Cash sitting idle loses value. If your money isn't growing at least at the inflation rate, you're moving backwards. 5. Recessions, why economies slow down. A recession is when economic activity declines for several months. Businesses slow down, layoffs increase, markets fall, spending drops. Why do recessions happen? High interest rates, debt bubbles, global crises, market corrections, economic cycles. Economies move in waves: expansion, peak, contraction, recovery. Recessions are painful, but they're not permanent. The people who survive them best have emergency savings, avoid heavy debt, keep investing consistently. Recessions don't destroy wealth, panic does. 6. Credit scores, your financial reputation. Your credit score is a number that tells lenders how reliable you are. Typical ranges 300 to 850. Above 750, you're trusted. Below 600, you're risky. It's based on payment history, credit utilization, length of credit history, types of credit, new credit applications. In 2026, this matters more than ever. Want a home loan, car loan, business financing? Your credit profile determines your interest rate. High score equals cheaper money. Low score equals expensive money. It's not about being rich, it's about being reliable. 7. Currency. Why money works at all. Money only works because we believe it works. Whether it's a dollar, rupee, euro, or digital currency, its value exists because society agrees it does. Governments issue currency. Central banks regulate supply. People trade it for goods and services. In 2026, we now live in a hybrid system. Physical cash, digital payments, crypto assets, central bank digital currency experiments. Money is trust. Break the trust, the system shakes. 8. Investing. How you beat inflation. Investing means putting your money into assets that grow. Main categories: stocks, bonds, index funds, real estate, businesses. Investing is not gambling, it's ownership. The wealthy don't just work for money, their money works for them. Time times compound growth equals wealth. The biggest risk? Never investing at all. 9. Value, the real source of wealth. Money flows towards value. If you create something people want, you get paid. Skills equal value. Solutions equal value. Innovation equals value. That's why doctors, engineers, creators, and business owners earn more. In 2026, high-value skills include AI literacy, digital marketing, coding, finance, sales, communication. If you increase the value you provide, your income ceiling rises. 10. Time, the ultimate asset. Time is the multiplier. Not income, not luck, not intelligence. Time. Invest $200 monthly for 30 years. That's how normal people retire wealthy. Most people underestimate what 20 years can do. Most overestimate what 1 year can do. Money compounds, skills compound, reputation compounds. Start early, stay consistent, let time work. If you understand these 10 principles, you're ahead of most adults in 2026. Money isn't complicated, it's just misunderstood. Learn the system, use the system, don't let the system use you. If this helped you, subscribe because financial ignorance is expensive.